Welcome to the Live Wealthy Podcast with Dawn, where we are growing our wealth and our worth at the same time. You ready? Let's go. My name is Dawn Dahlby, and I'm a certified financial planner as well as a behavioral financial advisor and the CEO of a wealth advisory firm called Relevé Financial Group. And this is episode 2 of a 2-part series where we're talking about the true cost of hiring a financial advisor. And what I've been doing in the first part of this episode is really taking a look at 2 different ways to pay an advisor. The first way is a flat fee, where you just pay a fee to get advice. And the other way is a percentage of your portfolio assets as assets under management. I've been going back and forth with the pros and cons, and myself as a fiduciary wealth advisor, I charge my clients and my entire wealth management firm, we're all under the AUM, or the assets under management, a way of charging our clients, which is approximately 1% of their assets. Now, as the clients' portfolios grow to 2 million, 3 million, 4 million and above, that percentage of fee actually decreases. However, the actual dollar amount increases because their portfolios are so much bigger. But what I've been talking about in the last episode and now moving forward is the value that the client receives by paying more than just a flat fee, and the extra value that they're getting. And what I've already talked about is the tax value. In the last episode, discussed that tax value that significantly reduces that overall investment or wealth management fee because of all of the strategies that we put together to help the client's income tax and investment tax. We actually do our clients' taxes as well. So we're really hands-on with the tax ramifications with their portfolios. But taxes are so significant in clients' overall rate of success that we're really trying to, for clients, is really minimize that tax bill, like I said, from both an income and investment perspective. The last episode, I talked a lot about went into detail about what we really do as advisors to work with the clients to minimize their taxes. And now moving forward, today, what I'm going to talk about is what we do from an investment perspective to help clients minimize the fees that they pay us and to maximize their performance. As I said last time, taxes and investments are such a key component to managing someone's overall wealth and their portfolio, and making sure that we're doing everything we possibly can to maximize the investment performance and minimize the taxes, because we get paid as advisors in our firm based on the results, the investment results of a client's portfolio. And so really looking at their investments and how to minimize the investment fees, the taxation around their investments, and then also how to minimize the taxation around their income is where you are going to see today what I'm going to talk about in a Vanguard study, that really paying a client, or paying an advisor, I should say, on a percentage basis, and how that advisor can really even almost or exceed 3 times the value of what a client would pay an advisor. Okay, so let's talk about investments, okay? As a fiduciary, certified financial planner, wealth advisor, some of the things that we do for our clients from an investment standpoint is, first of all, help them choose what we call asset allocation model, which is the asset classes of investing and having the right percentages of a client's portfolio in the right asset classes. What am I really talking about? Because some of you will be like, what? You're already boring me, Dawn, but I don't want to bore you, but this is really important stuff. What I'm talking about is an asset class is exposure to a combination of stocks, bonds, and alternative investments. Okay. So for example, as a regular retail investor, if you are a do-it-yourselfer, and you don't like to get financial advice and you're on YouTube or on Spotify trying to get all the information you possibly can from someone like me, what you will find out is that you can go ahead and buy stocks and you can buy bonds, but you don't have access to the alternative investments that our firm has access to as what we call an institutional investor. So we add in alternatives into clients' portfolios. An alternative is anything not a stock or bond. Typically, like some of the alternatives that we invest in our clients' portfolios are structured notes. There's hybrids of bonds and real estate. There's so many different things. There's commodities. There's a number of things, but just know that a portfolio construction, the correct asset allocation for clients is going to consist of a combination of stocks, bonds, and alternatives. And then really with that stock, bonds, and alternatives, really what type of percentage should you have allocated to stocks and bonds and alternatives based on your goals and based on the time horizon and really the risk you're willing to stomach with investing. For example, let's say you do this type of work with a fee-only advisor, and you guys put together a portfolio, an asset allocation model that says that you should have maybe 50% of your portfolio in stocks, 30% of your portfolio in bonds, and 20% of your portfolio in alternatives. Okay. Typically, what we see happen is that split between stocks, bonds, and alternatives, that 50, 30, 20% mix gets allocated in that same allocation gets managed in each accounts. For example, the 50, 30, 20 mix is allocated in the taxable account. You have that same allocation in your tax deferred account, and you have that same diversification and exposure in your tax-free accounts. However, if you're really managing clients' investments, the most efficient way is to take a client that has 50% stock, 30% bond, 20% alternatives, but allocate that overall asset allocation and that overall mix differently in your taxable bucket. You do it differently in your tax deferred and differently in your tax free. So for example, your taxable account might have more exposure to the bonds and or alternatives because we tend to put more conservative assets there. Your tax deferred and tax free accounts might have more of an allocation around 70% stocks, because we want those type of accounts, because they're tax deferred and tax free, to have more of an allocation to more aggressive investments. Okay. So just because you're working with an advisor and you're coming up with the right target asset allocation based on the asset classes of stocks, bonds, and alternatives, they're different per account basis. Okay. And that takes a lot of time to implement that for clients. And the reason being, again, why are we implementing this level of sophistication in clients' portfolios is because it's all about how to minimize your taxes and maximize your rate of return. In our firm, we pick a model portfolio, and Jake from who I talked about in our last episode, he is our investment analyst, and he is in charge of picking the right asset allocation models for our clients. Now, when we pick the right type of percentage, and it's not a one, portfolio, it suits every single client. Like I said, it's all based on the goals, the risk, the age, the time horizon, all of these things, which is an individual thing per client, right? Is their exposure to stocks, bonds, alternatives. But the other thing is that we pick these models, the percentage of stocks, bonds, and alternatives, we pick these models. But then what Jake does, he also takes a look at what is going on with the trends in the market. Like, what are we seeing from a performance perspective? And like, what is doing really well? What is not doing really well? And a few years ago, we had to make like active management changes to the model portfolio, not at the investment level. We're not at the investment level yet, but at the model level to take advantage of what we're seeing in the market. As you all know, that we have seen significant upticks in interest rates over the last couple of years, and inflation has been at a peak as well. And when that happens, that really it impacts and affects the fixed income or the bond side of a portfolio. Even though we might have exposure 30% for a particular client in bonds, we have to go like, okay, that 30%, should that 30% really be allocated in the bond portfolio the same way in a rising interest rate environment versus a decreasing interest rate environment? A couple years ago, Jake had to make individual trades in our clients' accounts. And so we had to actively manage this model portfolio to go more short duration in the bond side of our portfolio. And by doing that and being able to be real tactical with the portfolio, the model portfolios, what we have found is that the length of time that our clients experience negative performance was significantly less. Okay, so a lot less time in a negative performance environment. And we also discovered that the amount of negativity or the extent of negative performance was a lot less. By being actively managing the models, we found that we were able to save our clients a 4% less decrease in their portfolio by really making some tactical trades within the model. Okay, I hope this makes sense, but it takes at the end of the day, I want you to understand the work that goes behind the certified financial planner is the investment analyst, and our lead investment analyst, Jake Fromm, really takes a look at like what is going on in what's really going on in the markets, and how do we make some changes in the portfolio so we can have less volatility and of course less negative performance, and the negative performance from a time perspective, less time in a negative performing state. We call him Jake No Mistake inside of our firm. He makes mistakes just like we all do, but he's an incredible human being, and we are so honored to have him take the extra energy and time and the heavy lifting for our clients, for them to be able to take advantage of better rate of returns and less taxes in their portfolio. Okay. So another thing that Jake does is that he picks investments for our clients. So we pick the model, stocks, bonds, alternatives, different percentages for each client, based on their risk and their goals and their time horizon. But then what he also does is do all this due diligence around picking the actual investments. Okay. Should we be investing in mutual funds? Should we be investing in exchange traded funds? Should we be, investing in individual stock holdings? And within those like individual stocks, mutual funds, ETFs, then should we be, looking at more growth type of investments, like companies that don't pay a dividend, or value companies that pay a dividend? And within stocks, bonds, and alternatives, and within like mutual funds, exchange traded funds, or individual stocks, should we be an income type of producing investments, or should growth producing investments, ones that pay dividends, ones that don't? Like that's a whole nother level of diversification as well. And then what we do is, in that level of diversification, so there's a lot of different stocks. There's large companies, mid-sized companies, small companies, international. And then do we do, like I said, value or growth in each of those large, mid, and small? And then do we go with an active portfolio manager or a passive portfolio manager? What you're going to find out Not that I want to tell you everything we do in our firm, right? Because that is proprietary information, but US stock investments, it's really hard to outperform the US markets on a consistent basis. So we believe in saving our clients investment fees where we're actually going passive and not hiring a portfolio manager to manage the US side of the portfolio. But that's a decision that we have to look at and constantly analyze and do the due diligence on. And when I say we, it's the investment team to make sure that we're making really good decisions. And then when does it make sense for a client to invest their money and to pay a portfolio manager to buy and sell the individual holdings within inside of a mutual fund? Like, when do we do ETFs, which are passive? When do we do regular mutual funds, which tend to be more active? When do we hire those mutual fund portfolio managers to try to outperform some of the indices? Okay. So there's a lot of decisions that go along with picking investments and trying to be really smart with making sure that the fees and that we're really minimizing what's called the expense ratio inside of an investment. Okay. We pick the models, we pick the investments, we pick the individual type of investments, whether they're growth or value. And then we pick passive or active, like all of those things go along with picking really solid investments for our clients. But the other thing is that, so then we have the model, we have the investments, but then the markets are volatile and they change. And that means like the overall percentage of a client's portfolio, the overall percentage between stocks, bonds, and alternatives are constantly changing. And so we have to do what's called rebalancing the portfolio to keep the integrity of the risk for the client and not making them more aggressive by having more exposure to stock than what we've agreed upon in a client meeting, or not become too conservative. Because the markets are constantly in motion, we have to rebalance these portfolios. And really what it comes down to then is, again, there's 3 types of accounts. There's a taxable account, the tax deferred account, and the tax-free account. And then we have to be very cognizant on that taxable account, because if we're rebalancing investments there, it could cause some capital gain or capital loss. And so we don't just rebalance the portfolios within these 3 separate accounts based on the taxation of these accounts. We have to really be smart with how we're managing the taxable account and what trades can we make in those accounts based on the client's tax situation. And then how do we offset maybe what we can't do in the taxable account to offset that in the tax deferred accounts, like the 401ks and IRAs, or the tax-free accounts, the Roth IRAs, right? There's so much that goes into rebalancing a client's portfolio. And we have to rebalance the portfolio again, because we hold the highest standard in the industry to make sure that we are making solid risk decisions on behalf of the clients. Okay. So there's a lot that goes in with just picking investments. And it's really difficult to have, even in this day and age, a robo advisory platform that's going to be tax efficient with our investments. Okay. So we've come a long way where we can actually use technology tools to rebalance, but still from a taxation standpoint, again, your taxes are your biggest expense, right? We got to be very cognizant about that rebalancing and know the client so well that we know what tax bracket the client is in and how much gain or loss that we can recognize. And any type of robo platform is not going to be able to do that. They don't know the client that well to be able to do that. Okay. From an investment perspective too, it's one thing to invest your money and to bring in new contributions in, but there comes a time when you need to take money out of your account too. And really understanding when a client needs to pull out income, needs to pull out money out of their account to provide them income for whatever they want to do with that money, is to be very cognizant of how we are providing that money, that need of money to the client. So for example, a lot of times, people would say, well, if a client needs $10,000 out of their account, then we're going to sell the most conservative asset and, give that to the client. Some food of thought, some other advisors and analysts believe that, no, you're going to sell the investment with the biggest gain to provide that money, okay, the cash to the client so the client can do whatever they want with that money. It depends. Again, it depends. It depends on the tax bracket. It depends on what's going in what's going on with the client. Can they recognize more gain? Is that money going to come from a taxable account, or does it come from a tax deferred account where they're going to have to pay taxes on it, or should it come from a tax-free account? It all depends on the client's tax bracket, right? So we are making decisions on behalf of our client when they call us up and say, I need 10 grand, I need $20,000, I need $5,000, like pulling from which account and which investment can make or break a client's portfolio. Like we never want to pull money from an investment that happens to be in a negative performance territory, because all we're doing is locking in losses, and we're not in the business to do that. So that is another level of sophistication that needs to happen in a client's portfolio, because it's one thing to contribute in, but when you're starting to withdraw money, so if you're getting close to retirement or you need to withdraw money out of your portfolio, like how you go about doing that is so critically important. And then also knowing your client is really understanding like how much cash do they really need in their portfolio. And it's different for every single client. But if you look at, if you go Google what is cash paying at your bank versus the cash that's paying where we manage our clients' assets, which is at Charles Schwab, our cash right now is paying over 5%. Understanding what is their bank, where their checking account is, and maybe their savings account, what is cash paying there? What is it paying at the custodian that we are utilizing? And we use Charles Schwab. And then, how much cash should be held? Like that's all about you guys knowing your client and knowing how much money they're going to need to pull out in the future, in the short-term future, in the long-term future, and being really smart about the cash positions in a client's portfolios. Woo! Okay, you still with me? Because I'm still with you. Okay. One of my favorite things to do with clients, because I don't have to do that in-depth investment analyzation. Is that a word? Analyzation? Probably not. I don't have to do that type of analytic work like Jake does and Tom does on our team. However, the main reason for a certified financial planner is to be the quarterback of your finances, is to be helping you with the decisions you're making with your financial plan. Our job as advisors is to know our clients so well that we can really help them with those decisions. And I think one of the biggest decisions in financial planning is making sure the client is not over or under spending and saving their money. It's about getting the right type of alignment, right? So we don't want clients to oversave for their future. We don't want clients to undersave for their future. We don't want our clients to overspend today or underspend today. We want this proper alignment. And in order to get that proper alignment, we all need to do financial planning. So whether you're a fee-based advisor or a percentage of assets under management, it doesn't matter. Most of the time, us fiduciary CFPs are doing comprehensive financial planning for our clients. Okay. But I think the real value and what we implement at Relevé Financial Group is making sure that we're super efficient with the over and under spending and saving. Today, even I was meeting with a client and talking to them about their financial plan and looking at their financial plan of how many like what's their portfolio going to be at age 85 and 90 and 95. And we determined based on their current spending that they're going to have approximately $5.5 million left in their portfolio if they keep the current trajectory of their spending. And, I asked them, is that like, do you want to gift or give your one child that much money plus the house? And, they were like, I don't actually know if I want to do that. So we talked a little bit about leveraging their money through some estate planning. And I'm not going to go into that level of detail with you today, but there are choices when you have a big pile of money. By the time we think you're going to not be spending money because you're older, then like, what is the plan for that money? But what was really funny in the conversation is besides the estate planning and how to leverage the assets, but I talked about like spending more money today, like telling these clients, and they were traveling on a Europe vacation coming up. And I was like, you know what? Just like upgrade your ticket to first class. You have miles, you have money, it's either going to go to the IRS at the end of your life, or you can live a little bit fuller life and sit on an airplane for 12 hours in coach or in business class. Like, why don't you upgrade? And, again, I think so many times, especially our retired clients or clients that are getting close to retirement, they're so conditioned mentally to save and not spend and all this kind of stuff. But when you know your client so well and you know their money situation, like they can open up the purse strings a little bit and spend a little bit more today. And that's what I absolutely love helping clients do, is letting them see the big picture and letting them understand that, if it's a couple $1,000s more to upgrade it, then go ahead and do it. Right. That is such a blessing to be able to tell clients that. And we believe in the proper alignment of spending and saving in our firm. I think sometimes advisors want to be uber conservative with clients, or they don't want to tell clients they can spend more because it's just more assets for the advisor to manage. Right. Which is self-serving, that has no integrity. There's so many advisors out there that, that may do this. I'm not pointing to anyone and saying that they are doing this, but I have seen it in my 24 years of being an advisor where, the advisor can say, we would just want to be more conservative with the client's assets. No, let them spend their damn money. And let them have, look at the financial plan, know your clients so well so they can spend in alignment with their values and who they are as human beings, and know that like they're going to be okay and they're going to have way more money than they need to for the rest of their life. Okay. That's the value of financial planning. And in doing financial planning too, what really helps me as an advisor is like knowing where the numbers are going to end up. And saying, you know what, client, you might not need this type of, you don't need to achieve this level of result in your portfolio. So why don't we back off your risk and look at more of a risk-adjusted rate of return on your investments, which means that you can sleep better at night because your portfolio isn't bouncing all over the place, and you can still get that great rate of return, but on a risk-adjusted basis. We're taking out a lot of risk in a client's portfolio, and I wouldn't be able to do that if I didn't have a financial plan and know strategically where the client's going to be. Okay? So it's really about knowing the client and taking risk out of their investments so they can live a less worried life that they're going to run out of money. Okay. So more more in-depth conversations, with our clients around their spending, around their cash flow, around their debt, around, even knowing if they're still working, their benefits, at work and how to take advantage of those benefits, and what not to take advantage of. Education planning we do for our clients, like not only like how much you need to save for your kids' future college expenses, but where to save, right? And how much and where to save, and what do we think? What are we predicting is going to happen with education in the future? That's another thing. Education planning. What about protection planning, insurance planning, like making sure that you have the right beneficiaries on your insurance policies, but also on your investment accounts. You guys, so many times people don't update their beneficiaries on their investment accounts, and boom, something happens and the wrong person inherits their wealth. That happens. It happens. And who's listed as the beneficiary trumps any other estate documents that you have. Okay. So all of this other value add that's not related to investments, that's also not related to taxes, but it's related to your financial plan and making those really good decisions around all aspects of wealth, including insurance, including cash flow, including retirement planning, including education planning, executive compensation, employee benefits, like the list goes on and on. Okay. So there's a lot that goes into the fees that paying a percentage of your portfolio to fees. Yes. Can we reduce those fees if we're making smart investment and tax decisions? Yes. But remember, what you're paying that fee for is way more than just investment and tax too. Okay. You're also in our firm, like we are really big on client service. And, we also have this third party website, which is an asset aggregator. So what does that mean is that our client can log on to this third party view only website and see all of their assets, whether they're held at Charles Schwab, Vanguard, Fidelity, in their 401ks, it doesn't matter. They have a one place where they can log in and see the performance, the daily performance on all their assets. Like, how cool is that? That's true. Like giving clients, access via a super innovative tool where they can see everything with their investments, no matter where those investments are held. So assets under management, paying a fee, a percentage, 1%, 0.5%, a little more than 1%. But the value that you get is so significantly different than just paying a flat fee for advice. Okay. And I know this to be true because there was a Vanguard study that came out that said, the Vanguard study is called this. You can go ahead and Google this, and I'm gonna attach it to the show notes here. But it talks about putting value on the value of a financial advisor. Okay. It's like, what value does the financial advisor bring? And what is that value back to the client? And what they found through their research is that a financial advisor that's doing all of this work that I've been talking about can provide up to or exceeding 3% net return back to the client. Did you hear me on that? The value an advisor brings, if they're doing all of the work, they're doing the due diligence, they're implementing the financial plan, they're doing the investment rebalancing and the picking of the investments and the tax location of investments and the tax planning, all of the things that the true net return back to the client is up to or exceeds 3% value. Okay. Now I'll have to say that every situation is a little bit differently. So can that 3% value vary? Of course it can. It's all dependent upon the individual client's circumstances, but 3% value on average, okay? And what they found, what Vanguard, and by the way, I don't have anything with Vanguard. This is a total independent study. But what they found is that the biggest impact to drive that 3% net return back to the client was in behavioral advice. Ooh, behavioral advice. Okay. So what is behavioral financial advice? It's really examining your beliefs and your emotions around money and how when we're emotional with our money, we make really poor decisions. In fact, they say that the average investor receives half the performance of what the regular markets return because they make the wrong decisions. They make emotional decisions with their money at the wrong time. An advisor can come in and help guide you to not make emotional decisions with your money. It's about staying rational. Okay. So behavioral advice is about the beliefs you have about money. And by the way, we formed our beliefs about money by the time we're age 6, which is crazy. But sometimes we have to rewire our beliefs about money. We have to look at our emotions. We have to look at our spending and having the right type of spending strategies, which still allows you to live today and plan for tomorrow at the same time. Okay. We also have to look at, this is a good one. Strategies around if we're married and the different approaches we have with money than our spouse, right? Typically, a lot of times we marry opposite of ourselves. And so we have different approaches to money. One likes to save, one likes to spend. One might be more conservative. One might be more aggressive. We all have these different thoughts and emotions and upbringings and approaches to money. But the behavioral advice is getting on the same page or close to the same page with your spouse about spending and saving. Okay. So this Vanguard study, take a look at it. It's huge. And it's why I love what I do for a living, because I get paid to help people manage their money, but what they pay me and the result they get back, you cannot find that anywhere else in any other industry on this planet. Paying an advisor to manage all aspects of the relationship, the emotional relationship, the spousal relationship, the behaviors around spending and saving, the technical advice around investments and taxes and insurance, estate planning, all that you got to come together. You got to manage the entire relationship, because just getting advice from a technical perspective is not going to cut it. Just manifesting and understanding your emotions around money is not going to cut it. You need both types of advice, the behavioral and the technical advice, and to manage the entire client relationship to get real results. Now, my goal as an advisor is to help a client with their investments get a better risk-adjusted return than they could on their own that either meets or exceeds market performance. Even if it meets it, I'm cool with that. You know why? Because the goal is to pay less in taxes. The true value, the true expense is paying less in taxes and being able to have a strategy that allows clients to pay less in taxes today and tomorrow. Okay. It's about not just what are we saving you in taxes today. It's about keeping in a consistent tax bracket throughout today and throughout tomorrow, right? It's consistent performance. It's consistent low tax bracket. And the biggest honor I get by helping clients and charging them a percentage of assets is allowing clients to save more of their most valuable asset, which is their time. And as you continue to age, you are going to realize that if you want more money in your life, you got to be really cognizant about saving more of your time and not allowing the time that you have on this planet to be filled with making wrong decisions, getting caught up in the little things in life, the noise versus understanding the bigger picture with your money. It's the decisions. It's the decisions we make with our time that are the most valuable asset. So to wrap up, as you scroll through social media and you see posts or you see ads that say advisors that are charging a client a percentage, as you scroll through social media, I want you to understand and analyze what you are seeing, whether it's a post or an ad, because I believe so many times on social media, what we are doing is we are seeing ads that are grossly oversimplifying the value that a fiduciary certified financial planner can bring to the table. And they're undermining the perceived cost of what it costs to work with an advisor. It's just clickbait. Okay? So do your research, do your due diligence. I'm telling you, as someone who's been in the industry for over 2 decades, I'm extremely proud to be in this business, to hold the highest credentials, and to charge my clients approximately 1% before their tax benefits and before their investment performance, and to minimize their fees and maximize their performance and minimize those taxes, because we can see through the research that if a client can get on average a 3% better net return back to them by me charging them before all of the benefits, 1%, like that's really good math. That is a really good investment of your time, your money, and your life. So don't forget to own your worth, earn your wealth to grow your life.